Hello, I'm Ryan Lightfoot Amanoff of Kepler Trust Intelligence, and welcome to our Ideas for Your ISA webinar. Today, we are focusing on a topic that many of our listeners will know very well, the UK, and in particular, smaller companies. Joining me today is Matt Cable, Lead Manager of the Rights and Issues Investment Trust, to discuss his views on the sector, as well as how he aims to find the best opportunities from this very inefficient asset class. Now, for those of you who are new to our events, firstly, welcome. It is a pleasure to have you. We will be sticking with our usual format today, which will involve a short presentation of around 30 minutes before Matt hands back to me for some audience Q&A. If you would like to pose a question to a manager, please add it to the box on the right-hand side, and we will collate these together and ask them together to Matt at the end of the presentation. Now, that's plenty enough from me, so time for you, Matt. Without any further ado, please take it away.
Thank you, Ryan, and good afternoon, everybody, and thank you for joining today's call. As Ryan said, my name is Matt Cable. I'm Lead Manager for Jupiter Rights and Issues Investment Trust. Ryan, if you wouldn't mind just moving on to the next slide, and I'll just leave our risk slide up there so you can have a quick look while I set the scene. Agenda for today is to give you all a bit of an introduction to rights and issues, a little bit of the history, and a few facts and figures, and then to focus on the approach that we as a team take to managing the portfolio. And then I'm going to talk a little bit briefly about UK small caps and why we still think that they're an exciting place to invest. And then I'll give you a little bit of an update on where the company's up to at the moment. I am conscious that the context for today's call is another rather challenging period for markets and indeed the world. I'm not going to spend a lot of time talking about that in detail. Happy to try to answer some questions later on if people are interested, but not going to get into a huge amount of detail. The only thing I did want to note was that I've been through a lot of these periods before, and the one thing that always unites them is that when you look back at them with hindsight, is that they've tended to offer more opportunity than threat. But if you might, hopefully everybody's had a chance to absorb that one. Yeah, thank you, Ryan. So rights and issues. Rights and Issues is one of the UK's most venerable investment trusts. It was established in 1962, and when it was originally founded, it did focus on rights issues and other similar types of capital raising for companies. That process has long since been defunct. So that's not how we run the company at all now, although the name has stuck. So for most of its history, Rights and Issues was managed by a gentleman by the name of Simon Knott. So he ran it for nearly 40 years, pretty much as a one-man band from his spare room, and actually very successfully. Simon retired from portfolio management in 2022. He is still our largest shareholder, still sits on our board, while he's not directly involved with management of the trust. He's an excellent sounding board and has a huge amount of experience, so he's a very supportive figure for us as an investment team on the board. But really what the trust board wanted to achieve when they sought a new manager in 2022 was somebody who would take on the heritage of the company and of Simon's approach, but apply a modern and better resource platform to it. And that's very much what we think Jupiter has done. So in many ways, the trust continues to do what it's always done. It's a UK equity-focused portfolio, very much with a focus on smaller companies. And just for context, when I talk about smaller companies, we generally mean the bottom 10% of the UK market by value, which can move around. But this year means companies with a market cap up to about 2.5 billion at the point of investment. So we do have some large companies as well that have grown. It's very much a concentrated high conviction approach. So the portfolio is typically 20 to 25 stocks, very much a sort of best ideas approach for us. And we don't do anything complicated or anything else to sort of add risk to it. So there's no leverage. We don't own derivatives. It's very much straight equity holdings. So the idea is that it's very much a traditional approach, but delivered on a modern investment platform. And so to illustrate that, if we can move on to the next slide, please, Ryan. This is this is Jupiter's UK equity team, or the broader team. All the mugshots are investment professionals. Rights and Issues itself is managed by the UK small and mid-cap team, which is us at the top left-hand corner there. But we sit in a broader UK equities group, which looks at market in a variety of different ways. So obviously we're small and mid-cap focused. UK Dynamic, led by Alex Savides, is value and corporate change focused. The income team, growth team do what those names suggest, and then we have the UK Alpha team, who are a bit more all cap and blend focused. And the one thing you will see here is that although we're approaching the market in different ways, there's a huge amount of experience in this group around the UK market. Being calculated up there as 292 years of combined experience. What that means is that there's a huge amount of inbuilt knowledge of the stocks and the sectors that we all look at, even though we're implementing that in different ways. So that's the investment team, and then we just put a few. Sorry, Ryan, if I can just go back to that one. Yeah, just a few of the other front office teams that support the process. So things that you'd expect: ESG, stewardship, our dealers. And then we also have teams in areas like data science. And then, of course, beneath that, there's all the rest of the Jupiter platform, distribution, middle and back office. So it's very much modern platform with a traditional portfolio approach sitting on the top of it. So thanks, Ryan. So we'll move on now and talk a bit about our investment approach. We essentially talk about 4 principles to the small and mid-cap investment structure. And the core of it, as you'd expect, is very much fundamental stock picking. And I'll come back to that in a moment, because that's really what this is all about. But just to touch on the other areas that we think are important, and moving clockwise around. So we do bring a macro, so a top-down element to the way we invest. But what we're very clear on is that that's about being macro aware rather than macro led. So what that means is that we think about and respect the trends, the narratives that exist in markets, and where we can, we'll try to be aligned to those. What we won't do is try to forecast and anticipate macroeconomic variables. So there's absolutely no attempt to try to guess where interest rates are going, FX rates, and all the rest of it. But what we're trying to be is pragmatic and sensible and not fight market narratives, which can, of course, become very entrenched. Related to that then is risk control. Really what that is about is making sure we understand where the exposures of the portfolio are. So we have a number of tools, some of which are third-party tools, some of which we built ourselves, to understand how portfolios sit in the market, and to ensure that, again, what we're not doing is sort of fighting market narratives. And then the final element that's very important to us is transparency and partnership. That's particularly straightforward in the case of Rights and Issues, because we publish our full portfolio every day, so you can always find it on Regulatory News Service or on our website. So I'll move on now and talk about the stock picking process. And we really think about 3 pillars here, although as you'll see, only one of them seems to have its number on it. And the core of it really is growth. And fundamentally what we believe is that in the small cap world, the way you make money over the long term is to be on the ride of growth with the companies that make up our universe. So we spend a lot of time thinking about the factors of growth, and these can be very different things depending on the sector. But for example, there are things like strong brands, there are things like leading positions in markets. It might be a revolutionary technology. Those things which give companies a durable barrier to entry or moat that allows them to grow. And then on the other side, you're looking for some sort of growth driver. So whether that be big global themes, so one thinks about perhaps the green transition, or secular changes, shifts in the way that people shop or live or drive or whatever it may be. And it's looking at where we can find the intersection of those things. And a lot of that depends on thinking about business quality, which I'll come back to in just a moment. The second pillar, the one we've labelled upgrades, is really about identifying those situations where growth isn't fully appreciated by the equity market. So that might be where something has changed at a company and the market hasn't become fully aware of it and so isn't thinking about the growth. But equally, it's often situations where a company has been growing strongly and has a good growth track record. The market thinks that that's coming to an end, and we see greater durability for those reasons that I've just talked about to growth. And what, of course, you then see is positive surprises, and that is often a big driver of performance and value creation. And then the last element is valuation, which kind of ties those two together. So it's looking for situations where the valuation signal is telling you that the market, for whatever reason, doesn't believe the growth story or isn't anticipating a growth story that we can see. So the ideal investment is really pulling together those three elements: the exciting growth opportunity that isn't being fully priced by the market, and where there's a sort of some degree of disbelief amongst investors, and you get the opportunity to compound those three elements together. So what does that look like in practice? On the next slide, thank you, Ryan. Really, the core of this is business quality, and there are two aspects of this. So as it says here, it's hard to measure on a spreadsheet, but I mean, some things, of course, you can measure on a spreadsheet. So we do look at things like profit margins, historic growth, returns, but it's tying that together with perhaps some of the less tangible aspects of quality. So brands, so customer perception, people in a business, and that's really where we spend most of our time. So we do lots and lots of company meetings. We talk to suppliers, customers, even staff, and we do lots of site visits. So it's the shoe leather part of the process to really understand where business quality is. And then a huge and really important part of that analysis is management caliber. And it's an absolute article of faith for our team that management caliber is particularly relevant to small companies, where often that core team is critical to growing the business and to attracting the right people. So again, we spend a lot of time thinking about management experience, about incentivization, and then above everything else, about integrity, because so much of what we learn about businesses has to come from management teams. And so it's so critical that we can hang our hat on that. On the right of this slide, we've got the word timing. So to be clear, that's not attempting to time the market around events such as the ones we're currently going through. But to go back to that macro awareness, one of the things we do talk about is respecting narratives in market. So accepting that there will be periods where certain things do and don't work, and that trying to be absolutely purist and academic about this process will often hurt you, certainly in the short to medium term, and the short to medium term can be a long time. So as a very contemporary example, before everything blew up in the Middle East, the big concern in the market was around AI and AI disruption, and that's affected the share prices of a lot of good companies. But we respect the fact that this debate is going to run for some time, and so now is not the moment to go and fill the portfolio with slightly beaten up software stocks, because we can respect the fact that this debate is going to take some time before the market will get over it. So that's the process. I just want to touch briefly on UK equities in general, and sorry, UK smaller companies in particular. Accepting that this has been a tough place for a number of years, and certainly if you look at the flows from open-ended funds over the last 5 years, it's been pretty relentlessly negative. That's frustrating. And clearly somewhat related to UK politics and the big picture. But when you zoom out and look at the long term, one of the things that's clear is that UK small caps have generated strong returns over a very long period of time, and in particular, stronger returns than their large cap equivalents. What's important, though, is that you will go through periods where that doesn't hold. And certainly you get years where small caps underperform. And that time series is pretty volatile. But when you look over the longer term, it's definitely a feature, which we think is an attractive characteristic of our part of the market. And simplistically, we think a lot of that reflects the fact that by definition, companies start small and have long growth runways, and so that's fundamentally the opportunity for us. It's also a great place to be a stock picker because it's a very broad universe, lots of different sectors and types of business there. So it's a really good place to go hunting, and the proof point of that is if you look at the dispersion of returns in a small cap universe versus a large cap universe over pretty much any period, what you see is that there's much more dispersion of returns in the small cap world, lots more winners, lots more losers. And that's the opportunity to go out and be active rather than taking a more passive approach because the alpha generation potential is there. So we think it's an exciting place to play with a great history and a great track record, albeit accepting that at the moment we're pretty deeply out of favour. So Ryan, if I've just come on to our performance slide, and apologies, this isn't quite the format I'd have chosen, but I'm not going to dwell on the minutiae of this, other than to recognise that 2025 was a pretty challenging year for the trust, and there are really sort of three elements to that. One is related to the discount that the trust experiences. So this is the difference between the market share price and the NAV. So Rights and Issues for many years has had a regular buyback of its own shares. So typically in recent years, about £1 million a month. That's subject to a vote at the AGM, and last year at the AGM, one significant shareholder blocked the renewal of that authority. And to be clear, that's not Simon Knott, and it's nothing to do with Saba, who we don't believe are on our register. So somebody else who had their own agenda, and that led to a significant widening of the discount during 2025. We may come back to this later, but the AGM is coming up in 2 weeks' time, and we're hoping that we might resolve that situation. But that was a significant element last year. The second thing is that the trust's formal benchmark is the FTSE All Share. Our board are very clear that investing in smaller companies is an active decision, so we need to reflect that in relative performance. And as I said, last year was a really tough year for small caps, so that was a big part of underperformance. And then there was a degree of fundamental underperformance last year as well, which I'll touch on now. So again, Ryan, if you don't mind just flicking on to our attribution slide. So this is performance attribution for 2025. And the table just shows the top and bottom 5 most significant contributors to performance. It doesn't really tell you the whole story. So trying to break down the big themes that were going on last year, because I think they're quite interesting and illustrative of both how we run the portfolio, but also what was going on in markets last year. So by far the biggest positive performance contributor on a thematic level were takeover bids. So on that list there, Reynolds, Alpha Group, JTC, and actually for a time Treat were all subject to takeover bids. And this is a theme that we've really seen. And for context, that's 4 out of, by the end of the year, 24 holdings. So it's a pretty significant chunk of the portfolio were bid for, and 3 of those, the 3 at the top of the table, were completed. And this is definitely a theme that we're seeing in the UK market now, that as good companies trade on really quite derisory valuations, we're seeing other investors, and whether that's trade investors or private equity, come in and buy the companies that we own. And of course, that's a double-edged sword. It's great for performance in the short term, but it does mean that we lose these companies from the UK market, and I'll come back to that in a moment. Another important feature of last year was that we saw something of a headwind from stocks that we probably would never own for various reasons. And So that might be loss-making businesses. It might be businesses with highly challenged governance arrangements or that operate in jurisdictions that we wouldn't want to go near. And that could feel like coincidence, but I think actually is probably part of the same theme, in the sense that many of my peers will be looking for similar high quality businesses and things that they can believe in. And because they're all seeing outflows, that puts pressure on the price of good companies. It doesn't apply to the price of things that nobody holds. So I think that headwind is probably a structural feature in the short term. Having been through everything in a great deal of detail, clearly there was some fundamental negative developments, but there were also some fundamental positive developments. And actually, the net of that wasn't a really big feature of performance last year. The really big performance headwind last year was the underperformance of a number of what we would consider high quality businesses that were delivering broadly, or in some cases ahead of expectations. So poster child for that is the one at the bottom of the list, Gamma Communications, which had a torrid year from a share price perspective last year, delivered profits actually very slightly ahead of expectations at the beginning of the year, had a significant strategic step forward in terms of an acquisition in its big growth market in Germany, but the shares performed very, very poorly. And we've seen this repeated across the market. And actually, the underperformance of quality as a factor in 2025 wasn't confined to the UK at all. That's been seen around the world. I think, again, in the UK, that's been particularly a feature for the same reason that high quality companies tend to be better owned by funds. They're seeing outflows and therefore tend to be sellers and are putting pressure on these things. That clearly, it's difficult to know when that changes. But again, is something of a double-edged sword, because it's also created a number of opportunities. And again, Ryan, if you don't mind flicking on, what I'll show you on the next slide are the 5 new holdings that the company had during 2025. And as you'll notice, top of that list is actually JTC, which I've just mentioned as being a bid target. So JTC is a great example of this. It's a stock that we as a team know really well. We've owned it since IPO. It is a leading global fund administrator specializing in alternative institutional funds and private trusts. It's a high return, high margin business that's with a fantastic growth track record, both organically and through acquisition. And in the running up to the middle of last year, had just seen its shares underperform relative to its earnings growth. So having had it on the rights and issues watch list for a while, we bought a position, and rather remarkably, almost immediately, the company was approached by 2 private equity firms, one of which have bought it. So has almost immediately crystallized that value that we saw. As you can see, the difference between the average in price and where the price has got to today. So if that illustrated how it worked very quickly, the rest, I think, all fit into that prototype of what we think are really exciting, high quality companies that have had a tough time from a share price perspective. So rattling through them, Keller, again, a business that we've known a long time. It's the world's largest specialist geotechnical contractor, so groundworks contractor. It's actually been through a period of corporate change and improvement over the last 5 years, which have driven really impressive earnings growth, and now delivers very strong returns and much improved margins. So the company had done very well. The share price had somewhat lagged that, and that was the trigger to go out and buy a position for rights and issues. And as you can see, that again has been a really successful early performance from that investment, although it remains cheap by any objective standards. Johnson Services Group, UK and Ireland, linen and workwear business, I think hotel sheets and staff uniforms. Again, really strong track record of organic and acquisitive growth. The market appears to have decided that growth is unsustainable, and again, we've seen a derating of the shares, so a fall in the valuation of the shares, and a bought a position for rights and issues. That one yet to make its move. Ashtead Technology, again, very similar story, known it since IPO. It's an Aberdeen-based marine services company focused on oil and gas and the renewable sectors. Very strong track record of growth, excellent returns. But the market just again decided that this was a poster child for a softening oil price and an expectation that its market would go backwards. But we think misses the point that this is not about just riding a cycle, but is about fundamental share gain and growth of the business. So we've bought a position, as you can see, again, decent start. It's had a slightly more challenging time over the last week, as you'd imagine, given what's happening in the oil market. Finally, most recent addition to the portfolio, XPS Group. So it's a UK-based, largely pensions advisory business that's enjoyed several years of strong growth, and we think that actually that's now a virtuous circle, because by being a larger business, they're able to address bigger customers, and of course that feeds back on itself. The market clearly doesn't agree, and again has reduced the valuation on the shares. So we've added that to the portfolio, and again you can see that there's a variety of different sectors represented here. So what we're trying to do is find that pattern, strong growth, not appreciated by the market, but build it up into a portfolio with that's well diversified. So the final slide on here, as I said, the portfolio is published every day. I'm afraid that this is the portfolio as at the end of December. It's just when that was cut. But if anybody wants to go and see precisely where we are, feel free to go to the website. It's all on there. As I said, it's a concentrated portfolio in the sense that it's a relatively small number of stocks, but the way that we manage it is with quite a flat structure. So it's not about having 2 or 3 holdings that represent most of the NAV. The difference between the largest and smallest is not a huge number, and that's, if you like, that's the principal risk management tool that we have to ensure that we're protected to an extent by diversification, albeit we do want to benefit from the closed-ended nature of the structure by being concentrated and accepting that will create a little bit of volatility. So I know my half hour's nearly up. I mean, hopefully on that real whistle-stop tour, I've just shown you that what we've got here is one of the UK's sort of oldest, longest established investment trusts, and it's bringing together that sense of a really traditional way of running a portfolio that we've taken on from our predecessor, but combined with a really modern investment platform with a lot of experience, and with all the sort of the modern ESG stewardship, etc. Functions that we have here at Jupiter. And that we're facing into a market that, for all that it's sort of deeply out of favour and deeply unloved at the moment, we still find really exciting and still continue to find these great opportunities to invest in. So with that, Ryan, I'm very happy to attempt to tackle any questions.
That's very kind, Matt. Thank you very much for that presentation. We have had a couple of questions come in, of which we'll go through. We've had a couple as well come through email, so I'll make sure we try and cover off as many of those as possible. We're going to start with something you haven't mentioned, actually, which is income. Now, a number of your peers have been introducing enhanced dividend policies where it's paid out of capital rather than dividends. Is this something that you think the trust with rights and issues is going to a direction they're going to go down, or have you got a different dividend strategy in place?
Yeah, so clearly distributions is something that the board controls, but their guide to me is that they see the distribution as very important. I've got a couple of percent yield, but it's not the driver of what we do as investors. So on the investment side, I guess I'm in that traditionalist school that says any asset is only worth the cash flows it can generate. So dividends are important, and they're a really important signal of ultimately value in a holding. But I'm not constrained by the need to generate a certain level of income, which allows us to be more flexible in the way we invest. That does, of course, I mean, where we are today, for what it's worth, we very comfortably cover the distribution with income from our holdings. The board would have that option to dip into capital reserves if they needed to do so to maintain that distribution. And I think they are very mindful that some of our shareholders really do value that income stream. Not least, I suspect, Simon himself as our largest shareholder.
Thank you. There's a couple of questions I'm going to sort of push together on this one. It's mostly related to portfolio. What sort of environment would you need for your strategy to outperform? So not only for the asset class for smaller companies to have a bit of a recovery, but also for your trust to return to outperformance.
Yeah, so I would hope that the portfolio isn't specifically set up for any given macro environment. I think it's a very curious period, 25, because the one clear theme was this underperformance of quality, and I would never advocate lowering the quality of your portfolio in order to try to benefit from that. It's the one thing that just doesn't make sense to me. I mean, it's got to be the right thing to own good companies. The caveat to that is that in a lot of phases of the market, quality, of course, becomes quite expensive. The curious thing about this period is that that's not what's happened. So when we look at the portfolio on a style basis, it appears to be both overweight value and overweight quality, which is a bit strange. So do I need quality to perform in order to outperform the benchmark? Yeah, absolutely. Do I think that's exactly what I would consider an environment? I'm not so sure. Put it this way, I don't think that the UK economy needs to do anything special for the portfolio to outperform. I mean, as you'll see, even just on this list of new holdings, while there's a bit of UK exposure, and we're respectful of the fact that the benchmark will be somewhat UK exposed, and so we don't want to be completely non-UK, but of that list, Johnson Services is the only one which I would consider UK cyclical. You've got three stocks that are really global businesses and have very little to do with the UK, and XPS is much more of a defensive, UK defensive. So you shouldn't consider this to be a bet on the UK. Ultimately, global growth, global GDP is relevant for equities anywhere and always. And so, a period of relative calm and stability in absolute terms will almost certainly be helpful. And particularly, equities are always going to be somewhat rate sensitive. So, things which are painfully inflationary are just inevitably going to be an equity headwind. I mean, that is always going to be a cycle. And as I said, I am not going to try and time that. So that's just a sort of that's a fact of life, isn't it, as an equity investor. But broadly speaking, what we're trying to do is have a portfolio which is diversified both sectorally but also thematically, so that this isn't about trying to find a particular type of environment that will work. I mean, I think for UK small caps more generally, the huge challenge is flows, and that's over many cycles. What's always happened is that eventually turns and then becomes a virtuous circle rather than a vicious cycle, and then comes back at some point. As to what the catalyst is for that, that's really hard to say. There's obviously lots of noise in government and in our industry about initiatives to try to reinvigorate UK capital markets, and all of that could potentially help. My suspicion is it just needs the confluence of a few different things, and once it turns, then it becomes self-reinforcing, and will be really quite exciting. But I wish I knew what that moment was.
Thank you. There's sort of a follow-on to that question, actually, is talking about the valuations of UK smaller companies. Do you have any sort of comparisons for what valuations are at the moment versus long-term averages, and also versus the last time UK small caps were out of favour?
Yeah, I mean, long-term averages are always difficult because you've got lots of different rate environments. So you're always trying to put it into the context of where we are. So, absolutely, if you go back to 70s, very high interest rates, PE multiples would have been lower. And I think 2 years ago there was a genuine debate about whether we might get back there, whether we might get into an inflationary spiral, and 10% interest rates might really happen. I think most people would now accept that the much maligned central banks are better now than they were, and did a decent job. I'm going to probably get shot for saying that, but did a decent job, and have controlled inflation without interest rates going higher. So certainly my perspective is that, given the likely range of outcomes for the rate environment, that UK small caps are probably close to the lows that they've ever experienced. And certainly, and again, I appreciate this is dangerous using the US as a benchmark, but one of the things that I find fascinating is that if you go back to 2015, the FTSE 250 as a proxy for the sort of mid-cap space was traded on the same valuation as the US on a PE base, on a price earnings basis, which is sort of, you almost have to pinch yourself today to believe that was ever the case, because you've now got a sort of double-digit PE difference. And look, part of that is probably that the US market is overvalued, but you'd struggle through history to find a point at which that still holds. And the interesting thing is that even if you sector adjust it, and respecting the fact that clearly the US is, to a certain extent, is driven by a handful of big tech stocks, but even if you sector adjust it, the gap is high single-digit PE points. Attempting to quantify and say just how cheap the UK is, I think you can go round and round in circles on. But you only have to look at the flow dynamic to see just how out of favour our part of the world is. And I think that just tells you, valuation just has to follow that. And certainly when I look at it from a bottom-up perspective, when I look at the companies, they're businesses, and you see this, don't you? That some of our best businesses are relisted in the US, because it's just that take the same business, put it in a different market, and you get a completely different valuation. So I think all of that tells me that there's a valuation opportunity, but I'm nervous about trying to tell you just exactly how big it is.
Yeah, understandable. Thank you. I've got one more question on portfolio, and then we've got a couple of questions on the trust itself to the higher level. One of the questions on the portfolio is, in a situation that you've had with Gamma Communications, I'll just try and bring the slide up over there, where the fundamentals have been solid, but share price hasn't reacted. What do you do as a manager in that situation? Have you added to your position, thinking it's better value? Have you sold, going, it's just not going to be appreciated, or you've just held on to what you've got already?
Yeah, so these ones are always a challenge, right? And emotionally as much as anything. The temptation absolutely is, and my inclination is to say, well, the valuation doesn't make sense, and I'm going to buy some more. I think this comes back to that point around timing and market narrative, that respects the fact that, rightly or wrongly, that's where the market is today. I'm not trying to second guess that and be super clever and try to sell it today and buy it again lower. And there will come a point, the critical point is when that position size gets to the stage where it's clearly outside the range that we run all of our position sizes. And that's the point at which the debate really becomes, we've kind of got to do one thing or the other here. I'm not going to hold it at say 1% of the portfolio, because you end up with a whole portfolio of little positions. So that's the point at which you force a decision. But actually, all the research, all the history tells you that, investors in general, portfolio managers, are prone to over trading. And so one of the things that I've learned to do is just to sit on my hands, and take my time, because ultimately the only way to crystallize a gain or a loss is to actually transact. So there's been the debate about the point at which this is just can't get cheaper, which of course there is no answer to that. Things can always get cheaper, but no, largely speaking, we've left that position alone.
Okay. And sorry, this is a personal follow-on now. So, like, looking at your sort of 4 principles, how do you sort of feed in these sort of levels into that decision making, and what sort of help does Tim Service have in any of that?
Yeah, so across our team, it's a small mid-cap team, we run 4 principal strategies. So rights and issues, we have an open-ended small cap fund, which I run, and then Tim runs a mid-cap fund and also a long-short portfolio. And although we're looking for the same kind of thing in holdings, those 4 strategies have quite different time horizons, with rights and issues being the longest, and the long-short strategy, so this is specialist equity, having the shortest time horizon. And so Tim will be, in running that portfolio, will be the most sensitive to those risk signals, and will look to trade around things more frequently. That's really helpful to me, not because I'm going to do things as quickly as him, because that defeats the object of what we're trying to do with the trust, but because it makes me think about the right things. So and hopefully the rights and issues is the sort of the counterbalance to that, to the rest of the desk, that sort of brings that longer term thinking. And it's funny because, as I say, we're looking at the same companies and looking for the same things in companies, but by bringing that both short term and long term perspective, that's often quite synergistic, and extends beyond the smaller mid cap team. So again, debating with all those other UK groups, all of whom are doing something slightly differently. And it's bringing those multiple different perspectives that can be really helpful. As I say, for rights and issues, taking these 4 elements, it's you could almost put 90% weight on the fundamental stock picking. It's that's where the emphasis is, but bringing those other elements in is helpful. For some of those other strategies on the desk, that will be a much more balanced between these 4 elements.
Great, thank you. And moving on to some of the questions about the trust itself. You mentioned earlier in the presentation that Simon Knott, former manager, is quite a large shareholder. Can you just talk through the shareholder register and some of the sort of liquidity or scale issues that may entail?
Yeah, so Simon and his family are the largest shareholder, and then we have one other family vehicle that's significant. Below that, it's a much more traditional UK register. So wealth managers, lots of private individuals, the occasional fund manager. So inevitably that does create some liquidity challenges. The buyback has historically been the answer to that, and has been very helpful. Without that, we're always going to be a bit exposed to sellers who are not necessarily selling because they've got a problem with it, but as life goes on, and people need liquidity, and obviously helping with that is part of what we need the buyback for. So for most of the time that I've run the portfolio, we've had the buyback, and actually liquidity's been pretty good. Current position is a bit more challenging.
Okay, thank you. According to my clock, I have 1 minute to go, so I'm going to ask one more question just on the market level. Do you think that the FTSE AIM index has a future, or is it going to be eventually just wrapped up into the all cap?
It's probably not a 30-second question, but yeah, look, I mean, the tax changes, whatever it is now, 16 months ago, were softened on the basis that somehow doing things halfway would mitigate the pain for AIM, and then they were just dead wrong. And of course, what we've seen is an exodus from AIM, and inevitably, the best, most liquid companies have tended to be the ones that move first. It's really tough to see what the future is for AIM in the current environment, under the current structures. And yeah, one can easily imagine a scenario before too long where, first, LSE say just isn't worth doing anymore, and we're just going to roll it all into one structure. Where that leaves sort of IHT and all the rest of it is a bit sort of beyond my expertise. But yeah, it's a shame because the whole thing has been deeply disruptive for very little gain, and has taken up a huge amount of management time and company time, which always drives us crazy because we want them actually running the business. So it's all a bit sad. There may be something that sort of comes out of the ashes of an equivalent that something that suits growth companies, and I think we've had in the last week, we've had the very first Pisces listing. So it's a much longer story on how that might evolve, but maybe that at least that's sort of an evolution of the thinking about what the UK capital markets need.
Okay, well, we have hit our time now. So Matt, thank you very much for that. And thank you to all our audience for their Q&A as well. A recording of the presentation will be available on the Kepler Trust Intelligence website, where you can also review the latest notes on rights and issues, which went up on the website in the last couple of days. So you can get a full background on the trust, and how that works. It just leaves me to say thank you once again, Matt, for your time. It's been excellent. We really appreciate having you here, and for the audience as well for sticking around. Enjoy the rest of your day, and we will see you next time.